Hey, this is Brent from Wolf on Wall Street Trade with a market update for the week ending March 1st, 2019. This is a weekly chart of the S&P 500 with a 50-week moving average in yellow. And last week I started the video, and I'm just going to kind of pick up from where I left off. And I said I think the perception of bullishness in the market is actually a little bit greater than what's actually been happening the last couple of weeks. So here's the S&P weekly chart, and it's pretty much a doji star. So this is up for the week 0.4%, basically closed right about where it opened. Then we have the NASDAQ. This is up 0.8% or 0.085% for the week. And notice we have a little bearish hanging man candle there. The Dow Jones Industrials were actually down 0.2% on the week. You can see that here with a little red candle. And small caps IWM up 0.5% on the week. And you can see another little hanging man candle. And then we have the Dow Transports down 1.25% on the week when we had this little star candle the previous week. So picking up on my thought, let me go back to the S&P, that the perception of bullishness is a little bit greater than what's actually happening. Bank of America has been putting out reports and following up on some data that says that we've seen 12 weeks of consecutive outflows from equity funds, about $50 billion worth. So that is, let's see, 12 weeks. That would be from about here, week 1, 2, 3, 4, 5, going up to 12 right here. So as of last week, that changed. And we saw the first inflow into equity funds of $9 billion. Now, I don't mention this, I haven't brought it up, and I didn't think it was particularly useful because the market has been going up just fine without those inflows. But in my heart, I was thinking to myself, you know what, good for the little guy. This is the retail sector, more or less, the mom and pops of investing. And I just thought in my heart, good for them, because they're using this price strength to sell into. They're acting like the smart money and not the dumb money. It usually goes the other way around. And remember last week we talked about fear over here and greed and that pendulum swinging really hard. So anyway, the point is that the mom and pop or the retail kind of money is starting to flow back into the market over the last week. That's the fear of missing out trade. So I think while the S&P really did not much on the week, less than 0.5%, the perception is that there's very strong bullishness and the people just cannot stand it anymore. They have to get in. They don't want to miss out. So I'm not criticizing them at all. That's actually how I got sucked into the market in the late 90s. Driving home from work, listening to talk radio, and hearing, you know, the Dow was up how many hundreds of points each day. And I knew nothing about price charts. I didn't look at price charts. And, you know, I just kept hearing this, and said, you know, I should be in the market. I should be investing my money. And, of course, that was right at the top just before the tech bubble burst. The point is, I think what the market has been able to achieve is to rebuild confidence that was lost here. So we pretty much retraced this December sell-off. It took about 9 weeks to retrace what happened in 3 weeks here, but now confidence is returning and these investors are getting sucked back in, which is kind of where I left off last week. NASDAQ 100 or QQQ. So here's a daily chart of the NASDAQ 100 or QQQ, and what I mentioned last week was that it had broken below this trend line and was back testing it. Very similar to what happened over here in September of 2018. So now we have that change in character again, which I mentioned last week here, back testing the trend line. Every other major average except for small caps did the same thing last week. So we can add to this list the S&P 500. So it broke below that trend line and is currently back testing it. The Dow 30 doing the same, broke the trend line and is now back testing it. And the Dow Transports. In addition to that, a bunch of cyclical S&P sectors did the same last week. So let's look at a 5-minute chart of the S&P 500 and add a little bit more color of what happened last week. And again, it's just change in character. So this is the 5-minute chart, and for reference, this is where the market opened Monday. So this is the trend line I mentioned that was broken, and we have a couple small bear flags here. So I'm going to walk this chart back. We'll move forward through the week, and here's the open on Monday. Okay, so Monday prices opened higher. President Trump tweeted something 20 minutes before futures opened Sunday night about trade war resolution. The market got excited about that, gapped up the futures. Our futures ran higher and gapped up the market in the cash session. So let's walk through Monday. Makes a little bit of a higher high here, and then spends the rest of the day more or less selling off, and it comes down to this point on Tuesday. And what I mentioned on Tuesday was that it was forming a small bearish flag. Now, it's not a bear flag because bear flags take about 3 to 4 days, and they generally play out a little bit differently. You usually have more of an impulsive breakdown or a gap down, you get a bear flag. But I thought this was a bear flag or a smallish bearish flag on Tuesday, consolidating right there at the trend line that was broken, right? So one of the reasons I thought this was a bearish flag was I looked at VIX. It was doing the opposite. So here's VIX on the same chart, 5-minute. And it had a small flag here early in the week, relative strength and volatility. And this is on Tuesday, putting in a bull flag. And this is the downtrend line from February, from the start of the month. So it was doing it right there at the downtrend line. The S&P was doing it right at its uptrend line. So let's walk forward and see what happened. And Wednesday morning, we gapped down here through the flag. Now, Tuesday, I gave a measured move target for this bear flag, or bearish flag, and it was 27.75. So we'll see what happened here. The S&P went right down to 27.75 in the morning. And the way I came up with that target is pretty simple. This is a log chart. It's just a measured move from where prices started to decline to the start of the flag, from where prices broke down below the flag, and it came pretty darn close. Actually, I should move this up a little bit. So there's our measured move to 27.75. Now, what the S&P did the rest of the week was consolidate in what looks like a bigger bearish flag. So here is Wednesday, Thursday, and Friday. So this looks like a bigger bearish flag. And if it is, then if it breaks down below the flag, right in this area, it has a measured move going down to about 27.65. So it's not a huge move or anything like that, but you can see we have a week where the S&P is actually up a little bit, less than 0.5%, but we have these kind of bearish flag formations, and the S&P wasn't the only one doing that. Here's the 5-minute chart of small caps. Here's where they opened on Monday. They sold off all through Monday, all through Tuesday, and then spent Wednesday, Thursday, and Friday in this kind of bearish flag. So if small caps break down below about 157, or IWM breaks down below about 157, it has a measured move here down to about 153.70, and that takes out its uptrend line. So again, to be clear, these are changes in character. They're not changes in trend. If we jump back to the S&P 500, I'll go to a 15-minute chart and zoom in, so you can see what happened here on the week. And let me take off the trend lines, and I'll just tell you, what I mean by change in character. You can see that here with the flags. But as far as a change in trend, we still have higher lows here, higher low here, and we have higher highs. So higher high, and kind of went sideways the rest of the week. And that's why we have those hanging man candles where the open and close are nearly identical. So if the S&P breaks last week's pivot low down here about 27.75, and remember the measured move would give it a target down here of about 27.65, we would be testing the pivot from the previous week, the pivot low. We would have made one lower low, and that would start to put the trend in question. On the week, we have these bearish hanging man candles right here on the week for NASDAQ, and even on a daily chart over here on Friday. But that was not the only change in character. There were a lot, as you know, we covered through the week. Market breadth, which has been spectacular, also deteriorated. Okay, so let's take a look at market breadth, and this chart might be a little difficult to follow. It's the S&P 500 in red and green candlesticks, and this white line is the percentage of NYSE stocks that are trading above their 40-day moving average. Now, this is a indicator that runs like an oscillator. So over here you can see the percentage in white. So it runs between 0 theoretically and 100. So either 0% or above their 40-day, or 100%, or somewhere in between. And the kind of overbought, oversold levels change depending on what the market's doing. But we can see 2018 here, and one of the things I was pointing out through the summer of 2018 was market breadth. You can see it diverging from the S&P as it's making new highs. This was actually a pretty horrible breadth divergence, and over here, this actually was the lowest print going all the way back to the financial crisis, the end of the financial crisis in 2008-2009. So down here at about 3%, that was the worst since the end of a brutal bear market, a much worse sell-off than we had seen in December or in 2018. So as you can see, we've got this huge spike on the rally from December 26th, and it is at just a really what I would consider a very overbought level here, up around almost 90. I mean, going way back. So from that perspective, you know, you've got a very overbought, just like you had a very oversold reading here. And we talked about this last week, that pendulum swinging between fear and greed. Now, breadth changes are really something, it's a change in character. If we go back to like 2018 in January over here, we didn't have a huge spike, but it was just a very bullish market, and breadth was continuing to go up, and it changed rapidly in like a week. So this is January 22nd of 2018. This is the market melt up before the February sell-off, and you'd see that the percent here was about 71%. Okay, and just like a week later, the S&P really didn't move that much compared to January 22nd. It wasn't down that much, but breadth went from that print of about 71% down here to 49% in the course of about 8 days. So breadth really turned rapidly, and we got this big sell-off in February, as you might remember. And then if we look at what happened over the summer, the indicator had basically confirmed throughout April, May, June, and then somewhere around July it started making lower highs, and this really started to stand out last summer. And remember, this is the same area in September that the NASDAQ and the S&P were back testing trend lines. So it was a longer duration deterioration in breadth. So let's look at what happened last week, because until last week there were some hints. You know, I follow about 30 of these different indicators. Some were given some hints, but last week we saw a real change. And I'm going to use a 60-minute chart of the S&P. This is Friday's close to demonstrate this. So this is last week. Here, that's Monday's open. So this is all of last week, and you can see this indicator just deteriorated all week. So the percentage of stocks above their 40-day moving average went from about 88% here on February 20th, and then into the start of the week it started to decline 87%, and by Friday we got down as low as 74%. So this really hadn't been occurring at any point during this rally off December's low until last week, and in many cases this was the worst breadth since at least the start of February, and in a few instances all the way back to January 4th, which on a daily chart of the S&P 500 would be back here about 9.5% lower. So you've got some of these breadth indicators all the way back down to where they were here on January 4th. Also worth mentioning in terms of market breadth, this is the S&P from December 27th over here of 2018, and here's the rally. So this is the 30-day new highs for NYSE stocks. They're starting to fall off a little bit, and you can also see over the past week 30-day new lows are starting to increase, especially over the last week here. And that tracks with pretty much what I'm seeing on the 3C charts. This is 3C in orange versus the SPY here, and that's a 60-minute chart. So this shows a really strong divergence, negative divergence between 3C and the SPY, primarily the summer of 2018. You can see July, August, September, again, where we're back testing the trend over here. And we had good confirmation the early part of January, and it started to fall off when the S&P crossed about 2,700 or so. About right here, you can see 3C is starting to make lower highs. And on a more sensitive tactical 15-minute chart, we can see that same thing here. Let's just go back to the summer of 2018. did not get good confirmation at all here, was making a negative divergence with the S&P. You can see 3C falling off sharply in here as the S&P was more or less trading sideways in a big choppy range, and you can see it falling off here again, negatively diverging. And this kind of tracks with all the other changes in character, whether it be breadth or whether it be trend lines or whether it be the price action intra-week. So to wrap this up, we've got all of the major averages except for small caps below this trend line as of last week. So here's the NASDAQ, here is the S&P 500, also below this trend line. The Dow Jones 30, also below the trend line, and the transports below the trend line here. Another bearish flag developing there as well. And on the week, we have a bearish hanging man candle in the NASDAQ. Something pretty similar to in small caps. And transports have already put in a bearish engulfing candle on the week. So a lot of changes in character, not quite a change in trend yet, but like I said last week, I think this market is really frothy and it is due for some kind of correction. Nothing I saw last week improved the situation at all. It just actually got worse, even though we're not seeing a whole lot of movement in the market yet. So I'm going to leave it off there, and we will pick it up Monday morning. Have a fantastic week ahead.